Good morning, Market Chameleons. Everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show. Before we get started, please take a look at the shared screen. The disclaimer, be aware that neither Market Chameleon, Dimitri, or myself are registered investment advisors or a broker-dealer. If you're searching for investment advice, please search out a registered BD or investment advisor. This show is for informational purposes only around Market Chameleon tools and features. And with that, D, we'll start.
Yep. Good morning, everyone. I'm going to share my screen here. If you are joining us for the first time, quick note, Will and I, we do these shows in the morning to try to help answer questions you may have about the Market Chameleon tools, the data, or the analytics. If you do have a question, type it into that live chat on YouTube. Will's watching it, and he'll let me know, read it back to me. To give you guys a couple minutes to put those questions in, we're going to start out looking at our pre-market report, see if we could get insights, what's going on in pre-market hours, and then we're going to move on to our questions. So let's start pre-market. Up here, you will see this calendar view. It does let you go back to a historical date. If you click on it, you'll see what happened in pre-market on that historical date. We showed the last weeks of data and a summary stats of what happened. This way you could compare the most recent date, which is here, April 15th, with what's been happening in the most recent days. You could also eyeball it to see if there's any type of trend or unusual day that you could go back to. So far, let's look at today's date, April 15th, which is tax day, right? You got it. Last day to file your taxes, everyone. So today, so far, we see 654 stocks trading higher in pre-market, 280 stocks trading lower. We have 179 million shares trading on up volume, 46 million shares trading on down volume in the pre-market. And if we convert that volume to dollar value, we have $4.5 billion worth of stock trading higher, $1.1 billion worth of stock trading lower. So from that perspective, it looks like that the trading in the pre-market so far has a bullish lean, more positive lean. Let's look at it from a couple more perspectives, and then we'll move on to our questions. And as you scroll down, like I am, you will come to see a more granular view of what's going on in the pre-market. So now we have stock symbols, price changes, volume, alerts, and we have a list of our most active stocks, our biggest percentage gainers in pre-market, biggest percentage decliners. Just looking at the count, I see 116 stocks made it onto our biggest percentage gainers list. 53 made it onto our largest decliners list. And we do set thresholds for stocks to make it onto this list because pre-market trading, we could have very low volume, low liquidity. So if it meets those thresholds, the stock could make it onto this list, but that does include small cap stocks, ETFs, could be a leverage product, could be an inverse ETF, could be a closed-end fund. So to narrow down this list further, we could use our filters above. If you have a watch list and you save the group of stocks that you like to track, you could filter this report by your watch list. We're going to use this filter here in ETF. When we click on it, we get a drop-down menu to select from, and these are different ETFs. Let's select the top one, SPY, and you'll see when we did that, the report below got filtered by stocks that are holdings in SPY ETF. So what we did was filter this group to stocks in the S&P 500, right? Constituents in the S&P 500, and here we see 20 stocks made it onto our biggest percentage gainers list, 2 on our decliners. So that also points to a more positive sentiment in pre-market trading. And I think we looked at it from 3 different perspectives. They all indicate the same same way that there's a bullish lean in the pre-market trading. I believe I could see it over here. This little E is telling us that there are earnings coming out. So I believe Goldman Sachs came out with earnings.
Yeah, it's the start of earnings. I think we had
Start of earnings. So some of this is reacting to those. I believe like Goldman Sachs had a I looked at some of the headlines that their profits were up significantly this quarter. So
yeah, I think Friday everyone was worried about the Middle East and what could happen over the weekend. And
yeah, now it's coming back now that uh, played out. So we gave it a couple minutes. Well, if we have questions, I'll take them now.
we did have a question, and welcome back, Rob, from Rob. He says, I was looking at the historic price distribution report on Market Chameleon this morning. Perhaps Dimitri could talk a little bit about it.
From where on the top part, the price action analysis, or like on a particular stock?
What section were you looking at, Rob? Were you looking for an individual stock, or was it where were you looking for it in the site? I'll let him get back with that.
Yeah. While we're waiting, we did have another question. It was about Skew. So let me cover that a little bit, and I'll try to get Rob's question as well. But let's address this one question. It was from an email over the weekend, and I'm gonna look at SPY right now, options chain. So when we look at the implied volatilities, this is looking at an SPY, particular expiration April 17th. And when we look at the implied volatilities of the different options, you'll see that they're not all the same, right? You could see that here the implied volatility, this is the put side, call side, but as we move in strikes, you can see that the implied volatilities are different for each option. And, even going to the upper strikes, they're different. So they could be the same, they could be different, and they could, and sometimes they could be, sloping one way or the other way. So, in finance, when we're dealing with lots of numbers like this, all right, is how do we kind of how do we quantify it, how do we measure it, how do we define it, because there's lots of numbers over here. I got all these different expirations, and we could have different skews, and the skew is we're on a relative basis, how are these options relative to these other options. So it's a way to measure the relative implied volatility of options to the downside versus the upside, let's say. So this is a vertical skew, right, within the same expiration. And and when I talk about relative, it's you're comparing something relative to something else. So relative, like a P ratio, is a relative number, right? Because you're taking a price of a stock, and then you're saying, well, what is the price of the stock relative to the earnings per share? So you got a PE ratio, right? So how do we do that with the options? Because here we don't have, just two things to compare. We have lots of these options here. So we'll have to create some kind of like an index to try to, have like some key metric to give us an idea what the skew looks like. Is it, is there a skew? So is it if all the implied volatilities are the same, there's really no skew, right? If there are implied volatilities that are different, usually from the, you're comparing the downside versus the upside. then what is the skew? And with this, the challenge is that there's no real one right answer or one best way to do it. Just like with the P ratio, right? You could have a P ratio that's modified many different ways, and I've seen it like modified. You could have like 50 different ways to modify P ratio. But so the question was, looking at some of our stats and comparing it to like some of the academics, how they normalize the skew. So I'm going to show you here how we do it. And let me see here. Was it under? I think it's under activity here. So we do it a couple different ways. We don't have one way. We try to display it in different ways because it gives you a little bit of a different, perspective on it. And over here, we see in this activity this sheet, these are all the different expirations available in SPY. So within SPY, we have different at the money volatilities. So this is also a skew. It's called a horizontal skew or term structure. So, April 12th, April 15th, April 16th, you can see at the money volatility is different. And then within and we could just eyeball that, right, over here and kind of just tell like it's just increasing as we go up. Although up here in the near term, we did spike up a little bit, and that's because I think what happened on Friday with the anticipation of like that event over the weekend. So then how do we kind of do that quickly with the vertical skew, right? How do we kind of see the relative? Because here it's easy to eyeball relative implied volatilities. We just see them, 16.6, 16.2, 15.7. We could see how they compare versus each other. And how do we do that with the vertical skew? And we have different ways. And the question was, particularly on this report, it looks at a 25 delta put and a 25 delta call. And what we're doing here is measuring. Okay, I'll just pick one over here. April 15th, April 30th. The at the money volatility is 15. So the at the money is like where the strike and the spot price of the stock equal. So 15 is this number that we come up with, based on, a synthetic at the money, because you're not always going to get exactly at the money. And then from there, if we say, okay, here's the at the money, how are the downside puts and the upside calls look like relative to that the money? So to do that, first we have to normalize the deltas, right? And to do that, we're going to take that the money implied volatility 15, and we're going to run that through every strike, right? So we're going to pretend that what if there was no skew, right? So the first thing we want to do is say, well, what if there was no skew? If it was 15 every single strike, how would the options look like? Okay. So we run a straight skew. And then when we run that straight skew, then we could compare, well, here's the 25 delta call, here's the 25 delta put using 15 implied volatility. And we say, well, what does the market actually look like? All right, what in a 25 delta call, we're expecting it to be 15, but what is it actually? And let's just say it's 14 or 13.5. So we'll say, okay, well, that's 10% below, where we would expect it. right? If we were expecting a straight skew, and this is below it, what is the percentage below? 10%. Okay, if we're expecting this straight skew, where's the put? Oh, it's 10% higher. So now we have these two numbers, and we could now kind of get a sense of what that skew looks like. So I'm just looking at 10.8, 13.9, and these two numbers can tell me, okay, the downside skew is higher. Options are bid higher. The implied volatility is bid higher than that, the money. And what about the upside? Well, the upside looks like it's lower, right? 13.9% lower. So now I'm kind of visualizing what that skew looks like. It's sloping down as we go up, right? From up down. So, and then I could see the magnitude, right? So I could see that, yes, there's a pretty steep skew, relative to each other, going up and down. So this is how we met, this is the way we're doing it here. And the question was, well, when you read academic papers, or you're seeing how other people in academia do it, they'll say, well, instead of doing it this way, you could take the 25 delta put, subtract it from the 25 delta call, divide that by the money, and you get one number, right? So why not do it that way? So that was the question. Why not just do it that way? And by the way, if you click on it, I think you could see kind of this is what the skew looks like. And the reason we're displaying it this way, not just one number, the way that was described, taking the put minus the call, dividing it by the money, because then you have one metric instead of two. And I'll show you the reason here. It's because it doesn't really answer the question, and it will leave the questions basically unanswered. So let's say you have an at the money that's 100. So at the money volatility is 100. And now we want to see, okay, here's a 25 delta put, 25 delta call. Oops, sorry. Right. So let's say that the put is 101, right? And the call is 99 delta. We could see that the difference between the two, put minus call, is 2. If I divide that by 100, that's 2%. But you could get 2% based on different shapes. So let's say if it was 102 and 100. Well, that's still 2%. But this tells me it's something a little bit different. Look at the top one. The top one is telling me that the downside put is skewed higher. The upside call is skewed lower. But number 2 example says that the upside put is skewed higher, but by more, by 2%. But the upside call is flat. So now we're seeing, that the upside is flattening out. What if I did this? 104, 102. So 104 minus 102, that's also 2%, right? 104 minus 102 is 2, divided by 100, that's 2%. But now that's telling me something different too. What this is saying is that the smile, right, it's not sloping up or down. It's actually, it's like a smile. It's curving. Both wings are pointing up. Just the put side is pointing up more than the call side. So what happens is that when we do this, when you get 2, the next question is, okay, how does it look in? I still need to see that breakdown, because it could take on different shape, right? Different shape. So that's why when we do it, we do the calls 25 delta call relative to that money, 25 delta put relative to the money, because yes, the objective is always to try to create one metric, or the least amount of metrics to identify what we think is going on, right? Like when we're dealing with lots of numbers. But in this case, if we normalize it this way and we try to limit it to just that one metric, I think that it could lead to a little bit of confusion, and you're still going to want to know the next step. Okay, show me what that looks like. Does that mean that the downs, again, you could go, 198. So what I'm saying is that there's many different shapes that it could take, and you would still want to know, well, where is the skew? Is the skew to the puts? Is the skew to the calls? Is the skew, going both up? So that's why we show both normalize it and show both the 25 delta put and the 25 delta call, okay, relative to each other. That's what we did, and we think that is just a better way to display. You're getting more information than you would have if we just combined it into one metric. Now, can we do a different way? We could look at it a different way with one metric, and this is a skew based on a risk reversal. So if we go here, let me see here, strategy benchmarks. In a risk reversal, right? A risk reversal is basically doing also a skew, because we're looking at a upside call versus downside put. But we're going to define it differently now. Instead of normalizing it to the, to the at the money implied volatility, what we're going to do is say, we're going to look at a 5% call above at the money, 5% put below at the money. Okay, so that's what we're normal. It's based on the distance from that the money. Okay, so it's always the percentage distance away. So here we have a 5% out of the money call, and we defined it as 30 days constant maturity. And we have a 5% out of the money put, 30 days constant maturity. So you need to define the maturity, right? If we're gonna use a benchmark, the benchmark needs that consistency. So we have a 30-day constant maturity option. Remember, this is a synthetic now. We have to create it based on the surrounding data. And then we're gonna keep it always at 5% around. So to narrow down to one number, we're gonna say, okay, what is the premium, right? The premium of that call. So the premium is based on what is the cost of the call relative to the price of the stock. Okay. And then the premium of the put. So what would be the cost of the put as a percentage of the price of the stock? So let's say the call is then, 2%, and the put is 1%. So you're paying 1% more, 2% minus 1%, right? So you'll be paying 1% premium over the relative to the cost of the stock. So this way we could track it. So see here, now we got it to one number. So what is this saying? Negative 0.2%. So negative 0.2% is saying the following, that if we took the 5% out of the money call and took that premium, and then we subtracted the premium of the 5% out of the money put, well, if the put is more than the call, this will be negative, right? Because it's call minus put, right? So this will be negative, which it is. And then if we took that number and divided it by the price of the spot price when we took it, let's say, okay, well, how much would we bring in or pay? Here you're bringing in 0.2%. Meaning, yeah, you bought the call, you sold the put, but you net brought in a credit, right? And how much is the credit? Well, it's 0.2% of the spot price, right? So that's how we're normalizing, because remember, spot price could be changing all the time, and the premiums will change relative to that, right? So now we have this number 0.2%. We could compare that, and now we could compare that to historical 52-week average. We could see how it changes over time, and we could do that for the 60-day maturity, 90-day maturity, and 120 days. So this is just a different way. We looked at two different ways to try to measure skew. And I think I wanted to show you this because there's no right way or one way to do it, right? There are different ways that you could try to do it, and they'll answer you a little bit different questions. But the point, was, why do we put in the example of where we're looking at the money IV, we just thought that looking at the call and the put separately makes more sense. Okay, it'll make more sense to you, because if you looked at that one metric, and we've done it many different ways, it's going to leave you with questions anyway that you're going to be like, I need to see them separately, because I don't have the answers. I don't have enough information to understand it. This way, it narrows it down to one number, which could make more sense, but it's normalizing it based on the cost, right? Not the IV, but the actual relative cost of this strategy, right? And it's normalized based to the stock price. So what we read up at 9:30, I'm going to end it there, but I'll take Rob's question maybe tomorrow.
Yeah, that was super helpful. Why don't I just show you where it is so we don't forget? If you go to reports,
Yep,
up stock, and then reports, it's under tools, price action analysis. That's what he's.
So when you say stocks,
and then
reports,
for premium users,
price
it's
action.
under
Okay,
tools, actually.
Yeah, so we'll go over that tomorrow.
Awesome. Great
All
job,
right.
Deem, as always.
Yep. Thanks everyone for joining. Stay safe out there. Have a great trading day, and hope to see you